Hello everyone, Clifford Bennett, ACY Securities. We've had some big news out today about China and setting its target of 5% GDP growth, which is in my range over the next decade of 2.2 to 5% growth for China. So they've gone and shot for the top of my range, which is very nice of them. And of course, China likes to set targets that can be exceeded. So I wouldn't be surprised to see if China's GDP growth this year is actually 5.5, 5.6, 5.2, 5.3, but they'll really want to push it because they'll want to prove that they can exceed their target. And that's been the nature of the beast for basically a couple of decades now. However, there is a real change in how China perceives its economy and the outlook for its economy. And I think it's very important to note that in previous decades, what we saw over the last couple of decades, where we saw China moving really from an agrarian economy, really was. There are 800 million farmers with small-sized homes and farms. Moving from that to aggregation of farms was allowed in recent years, but also moving to an industrial society and a highly consumer-based society, akin to that of the middle class of the United States. We all know that the middle class equivalent of America in China now is probably up around 350 million and growing, and the whole population, 900 million. The process isn't complete. The whole population, 8 to 900 million, is living pretty much a Western lifestyle. And in many ways, many of the wealthy are far wealthier than those in the US. So they have their global brands, and there was a big shift many years ago. In fact, I gave a talk in Beijing at the Caixin conference several years ago, where I said China was now going to shift. They asked me to speak about their future trade patterns. I'm not sure why they did that, but I said that China's now going to shift from made in China means, low price value, to made in China means quality products as well. And we've certainly seen that movement. So quality has become a key, sort of the driving force really, whereas low price was the initial global competitive impetus to this shift from agrarian industrial consumer. All of this matters because what's happened with the COVID pandemic is that it has been an economic masking of the underlying changes and shifts taking place. So people have missed the point that China had tipped over in any case into a sustained period of much lower economic growth, which is the new normal, and we are already there, which is growth rates more akin to those of the very mature capitalist economies of the world, like Europe, UK, and the USA. Of course, not doing as badly as those economies are doing, still growing sort of 2 to 5 and probably a lot of time in the top half of that range. Whereas the US and Europe are really struggling to even achieve the bottom half of that range. But it is more akin to the Western economies. And that makes perfect sense. And I remember when US economists used to complain that China's growth was too fast, maybe a little bit of envy economics there, and they used to want China to slow its economy. Then when China's economy slowed, they said, look, China has problems. So, China's never been able to win in really the analysis of the Americans very much for, but we all know that. And some of the analysis of the Americans is correct, but all I'm saying is there is a bias there. And we do see that play out in the economic commentary realm as well. What we are likely to see going forward, as I say, is 2 to 5% growth for China, that this will be a continuation of outperformance of the United States and other Western economies, and therefore it's good news. But people need to take into account in their long-term investment portfolios that this is not the aberration, and then we're going back to 8, 9, 10% growth again. That's gone because that was a function of the shift from agrarian to industrial consumer, the shift largely being over. Of course, it's going to take years to be fully completed, but the bulk is now completed. And we can expect growth rates to be more normal in an advanced capitalist economy. Now, people often get confused about those terms. It is very much a capitalist economy with state influence, but in many ways, the Chinese economy is more laissez-faire than the economies of Europe or the United States or even Australia or Canada these days. So there is a capitalist impetus and dominance in that economy. However, there is state intervention as well, but we probably see even more state intervention in the US and Europe, Australia, and Canada at this point through the overregulation of those very mature capitalist democratic systems, as opposed to the just maturing capitalist single-party democracy system of China, which some people would call it to be an autocratic, perhaps political system, but the economic system is largely capitalist. So this is going to be an underlying fundamental strength of the Chinese economy and society moving forward. 5% growth is a great reacceleration post-COVID. It may not be sustained, and that's why I think we could still settle into that 2 to 5% growth path long term for China. And people should take that into account, as I said. Now, in the US on Friday, we saw services data really pick up and gather speed, but there's this start of the US year economic phenomenon, which may not be sustained. But nevertheless, even if it isn't, it is clear that at some level there is some stability in the US economy. So it might be stepping away from that free fall character that it had previously. And then there's more inklings that there could be some lasting stability, but I would not expect that sharp January, February data to be maintained during the year, especially as the Federal Reserve will be continuing to hike rates. Now, we saw spectacular rallies in stocks in the US on Friday, and even though I'm a bear, I was personally buying because of the nature of how that market works during that US trading session, which is that the 40% of the S&P 500 daily volume now consists of one-day option trades. Or is related to the hedging of those trades, which just leads to ever greater volatility, which in the long term will be unsustainable because it just becomes such incredible chaos that in the end, pretty much everyone who's trading short-term loses. They step away from the market, trading volumes end up dropping. So the people who are running these programs and marketing these products in the long run are probably doing themselves and the market a disservice. But I could be wrong. And the market just has to learn to adjust to this new reality. But it certainly is a reality that if the volume of these transactions and their hedging and re-hedging as markets move around on the day is 40% of the daily turnover, it becomes a dominant force, which is why we've seen price action movement that had no association whatsoever with the latest news developments, with the chairman speaking or inflation or economic data, only a momentary blip in respect of the data and then something else completely taking over. And this explains all of that process, which means we're always left with the question, when it's a strong momentum up day or a strong momentum down day, is that move really reliable from a price action study perspective? Given that we've had two strong up days in the US 500 index now, it's probably a little bit more reliable. And when you look at some of the price action of some of the bigger companies like Tesla and Apple, so two sort of different fields, but still technology, their individual price action looks a little bit encouraging. So as with the economy, there is a little bit more encouragement of perhaps stability in the equity market too. So that's something to be mindful of. Now, the caveat to that is if we were to see Friday's gains given up too quickly at the start of this week, then we go into another crisis to the downside mode. So just on Monday, because the momentum built from Friday, it always carries into the Monday market. There's people over the weekend here that the market had a strong up day and they decided to buy on Monday. But just see how Monday afternoon and Tuesday go for whether this is, a medium-term base for US equities or just a medium-term sideways consolidation with those Fed interest rate hikes still to come this year to further bite into consumer and business activity and therefore corporate earnings, and therefore, as I've said previously, stocks here in the US are probably still extremely overvalued. I hope that helps, and all the best for your day and for the week. Clifford Bennett, Chief Economist, ACY Securities.